Okay, so I started recording. Welcome everybody. Thank you for joining us. Know your numbers. As I said, I'm Stuart McFarlane Bedford from CDI Alliance, and let me hand over to Jo from Business Works, who's going to run through her presentation called Know Your Numbers. Over to you, Jo.
Thank you. Good morning, everybody, and thank you. Well, it's afternoon now, I suppose. Thank you for joining us today on this super snowy afternoon in North Yorkshire. So if you guys are all from the North Yorkshire and York region, I'm sure you're seeing the white stuff come down just the same as I am. And I'm being glad for a change, perhaps, that we're working from home because of COVID. Who knew that it would be a blessing in disguise? So today we are going to be talking about knowing your numbers, but why should you listen to me? So I am a qualified accountant and have been for 20 odd years, and originally started off in industry. So I'm a management and commercial accountant, which in itself potentially sets me apart from your average accountant in practice, because most of those people, accountants in practice, are either financial chartered accountants or traditional chartered accountants and auditors. And I employ a group of people like that in my practice to do sets of accounts. I don't do sets of accounts, but I do work with businesses on understanding their numbers, looking at management information, helping them with growth strategies, tax strategies, all that kind of thing. So for 20 years, I worked in industry, and I worked for some big blue chip companies, as you can see, mostly manufacturing, mostly chocolate. And after being made redundant 3 times, decided that I would start my own business. And given that I was an accountant and accountancy was pretty much all I'd ever done, I thought, why not be set up an accounting practice? I'd never been in an accounting practice at that time, so I'm not hung up on the traditional ways of accounting practices. I took out a blank sheet of paper and thought, well, what do businesses actually need from an accountant? With the skills that an accountant has, how can we support and help businesses to thrive, as well as doing tax returns? And that's how I set up my business some 13 years ago. So while I was in industry, I did all of these things on this chart: the pricing, the modelling, the budgeting, the forecasting, the management accounts, many of which we're going to talk about today. So I do have many years of experience in industry where my role was predominantly to do those things, and now working for small businesses, doing those things for small businesses too, because why should it only be big blue chip businesses who have good quality management information with which to make management decisions? So these are my contact details. If you did have any questions after the session today, then feel free to contact me, hook up with me on LinkedIn or on our Facebook page, or on any of those usual social media platforms. So what are we going to be talking about today? We're going to be talking about 3 main things. One is what the difference is between profit and cash flow. It is something that we get asked a lot and things that people get confused about a lot. So I'm going to demystify that for you today, hopefully. I'm going to talk about KPIs, key performance indicators, what the most common ones are out in the marketplace, and who might be looking at them, and which ones should you be actually spending time, effort, or potentially money, if you're having other people work them out for you, in doing. So we're going to have a look at KPIs, what they mean to you and which ones you should be using. And we're going to have a look at management information. So when people talk about management accounts, management information, what are they talking about? What do they look like? What typical things would you pull together for management information, and how would you use them in your business? That's what we're going to look at. So we're going to start off with this. Okay, so what is the difference between cash flow and cash and profit? So what is profit? Well, fundamentally, it's an accounting term, or a number of accounting terms. So it can mean lots of different things to lots of different people. So if you say, I'm making X amount profit, then that isn't enough information typically for people. Typically, people will need more information than just the word profit. So it can be an accounting term. It's also something that you're taxed on, which is a different calculation again. So what is profit? Well, typically profit would be either gross or net profit. So gross profit is that part of your profit that you make after taking account of costs associated with making the goods or services that you sell. So that would be if you're manufacturing, if you're making goods, then that would be the cost of the raw materials that you're putting together to make the things that you're selling, and the cost of the labor for the people who are putting together the goods that you've bought in to make into finished products that you will sell. That is gross profit. So for me as an accounting practice, my accountants, the cost of those accountants sit in there when we come down to gross profit. But things like the costs of officers, insurances, rates, administration staff, all of that kind of thing sits in your overheads, and that then is taken into account when we look at net profit, as is interest, depreciation, all costs associated with your business. So when people talk about gross profit, it might actually be quite a high percentage. You know, lots of businesses have gross profit of 50% or more, but their net profit might be, often is, significantly lower than that and can often be single digit. So that's the difference between the levels of profit. So when we're talking about profit, we should say more than one word. Saying just profit is not good enough. What kind of profit are we talking about? Are we talking about gross profit? Are we talking about net profit? People talk about in industry sometimes things like EBITDA, which is, you know, economic profit before tax and depreciation and whatever, you know, and there's all sorts of different ways of calculating it. Make sure if somebody's quoting profit to you or you're quoting profit to somebody else, then you know exactly what kind of profit it is, because there's a good chance that you're going to get asked. And if you, like me, are an avid watcher of something like The Dragon's Den, and people are asked, okay, so what's your gross profit? And then they start quoting some crazy numbers, it makes people think that you don't know enough about your business. It takes away their confidence in you as an owner manager of your business. So if you're ever looking to sell your business, if you're looking to get commercial finance, get access to commercial finance, then you may be asked for these kinds of numbers, and you need to know what you're talking about so that you don't end up getting yourself in a pickle with people. People talk about profit margin. So profit margin typically would be a percentage, and that can be at either gross or net level. So I'd said earlier about, you know, when people talk about gross profit, it can be often, you know, 50% or more, whereas it's a smaller percentage when it's the net margin. But then what's markup? Because people also talk about markup. And if we're talking about people getting confused about terminology when it comes to finance and numbers, markup and margin is another huge area where people get confused. What is the difference between these two things? Well, let's have a look at an example, because I think sometimes that's the easiest way. And I do apologise for putting numbers on a slide. I am an accountant. I've tried to keep the numbers limited wherever I can, but sometimes you just need to do some sums to get an understanding of what you're talking about. So in this example, we're ignoring VAT, can I just say before we start? So we're ignoring VAT. In this example, we're assuming that we're not VAT registered, and we've got a selling price of £10. The cost of our goods are £5, so we've got a gross margin of £5, which is 50%. And that is calculated as the gross margin divided by the selling price. But the markup takes the cost of the goods that you're selling and puts a percentage on top of it to work out how much to sell it at. And this is often used in retail. It's used in other industries as well. And sometimes it's called cost plus. I mean, I've been a pricing manager in the past, and in industry, sometimes they call it cost plus. But in this case, because we've only spent £5 on our goods and we're selling for 10, then we've got 100% markup in that case. So hopefully that is quite a simplified example that allows you to understand the difference between markup and margin. Okay, so let's have a think about some of the ways we calculate profit. So we would calculate profit from management information. And when we calculate that profit, if we're calculating it for a period of time, which we would be, for accounting purposes, we only need to calculate that for a financial year. And when your accountant comes to do your accounts at the end of the financial year, they will use something called matching. When we do our accountancy qualifications, our souls are tattooed with matching principle and other principles, certain accounting principles that everything we do from then on in, like Blackpool Rock down the middle of us, we can't help ourselves but employing these principles. So I'd say that they were beaten into us, but somebody might think that was literal, and obviously there was no beatings while I was at university or doing my professional qualification. But it's repetitively drilled into you that this is something that you have to do. If you hear a noise in the background, by the way, I have 2 dogs, and one of them is asking if she can go out into the snow. She doesn't like the snow. The chances are she just wants my attention. So I'm ignoring her. So, matching principle, what does this mean? The matching principle says that within any accounting period, so like I say, your accountant will do this at the year end, you must take account of only the revenue and only the costs associated with that period of time. And we match the two. So we're going to talk about matching principle again on another slide, and I'm going to give you some good examples of this. But it's all about what you've consumed. So some costs you incur them, but you haven't consumed them. And a great example of this is stock. So if you buy in, when I was at university, we used to get told to use widgets. Widgets, I don't, widgets. So you would buy 1,000 widgets and you're turning them into something that you're going to sell. And you've got 500 widgets in stock. You would take account of that stock. You would take the cost of that stock out of your cost base because you haven't yet consumed it. You could sell that back to the supplier, theoretically, but you haven't consumed it in the sales that you have made during that period of time. So depreciation is another thing. You might pay £5,000 for a piece of kit. You don't consume all of that piece of kit on the day that the invoice comes in. You may have it for 10 or 20 years, using it in your business for good use, for converting things, producing, manufacturing goods, whatever that might be. Same with vehicles. So they're depreciated, they have a life. So in accounting terms, we spread the cost of that over the life of the asset. And again, that is about matching. It's about saying how much of that cost did you consume in year 1, year 2, year 3, matching principle. Now, when we're calculating profit for tax, we've got a different set of rules again. So we still use matching, and we would do things called accruals and prepayments for this matching. And again, that's something that typically your accountant would do for you at the year end. But another thing that we have to consider when we're doing a year end for taxable profit is look at the difference between depreciation, as we've charged it for matching purposes, and capital allowances and things like annual investment allowance, because we're not allowed to charge depreciation to tax. There's other rules involved for that. And we will also exclude things that have been consumed for personal use and client entertaining and that kind of thing. So if you look at your profit that you've been given for the end of the year and then look at your tax and go, well, that's not 19% of that, then that could be because as part of your tax calculation, there has been some other calculations going on, which has converted the business profit for the statutory accounts into a taxable profit, which can be higher or lower dependent on circumstances. So let's just have a look at then this matching principle, because your accountant's going to do this at the year end. But if you want to have monthly management accounts, somebody needs to be doing this every month, because you're going to incur costs throughout the year, which will create what I call lumpy costs. So you're going to end up with lumps in your costs that will make your costs blip upwards. Let's say you got your insurance came through and that was £3,000 for the year and you incurred it in March and your year is the calendar year, then you're going to incur that between March and the end of the calendar year, but that had nothing to do with January and February. So you only want to be consuming 10 months of that during that period of time. Or the way I like to do it is split it through by 1/12 and have it 1/12 appearing each month. Nice smooth numbers coming through that I can plan for, I can manage, and I can understand. My management information on a monthly basis is meaningful because I have smoothed out the lumpy costs within my business. I don't have stock, as you can imagine, of goods. But if you have stock, you should be doing stock counts every month and making that adjustment into your accounts. And you should be doing these accruals or prepayments for any costs that you incur once in a year as a written invoice. You may even pay them monthly, but we're talking about profit here. We're not talking about cash. And then smooth those over the year so that your costs are not going up and down like this, which will make your margin or go up and down like this too. And how are you supposed to manage your business with numbers that are going up and down, and then you're going, oh, well, that's just because of the lumpy costs. Well, that's no good to anybody, is it? Are you making money or are you not making money? That's what we need to know. So another one of these accounting principles that is tattooed onto our soul is called prudence. And prudence says that you can only recognize costs at the time when they are earned. So when goods are dispatched, typically they legally change from your ownership to that of the person buying them. So that is the time that you would recognize that as income in your business. And typically that's when invoices are raised on the day that goods are dispatched. If they're dispatched somewhere a long way away, sometimes that can be when they reach the border or when they're received, but in most cases it would be when they're dispatched. It can be when a service is delivered. So today I am earning the fee for producing this particular webinar, not prior to this when I got booked for it. Now, today, this is the day that I earn this revenue. So I can invoice this and leave it in on this day. You might, though, need to work out work in progress, because what I might be doing is producing a set of accounts. It might take me 2 months to get all the information back and forth, back and forth. If my year end falls in the middle of that, I've got some work that I haven't invoiced yet. And really, I've earned that money because I've produced the goods. I haven't produced the end good, but I've produced part of it. Imagine if you were a house builder and you got your workmen out to site and they put the foundations in and we were up to the first floor and you were creating an invoice, maybe a staged payment. But what about if you weren't at the point where you were at a staged payment, but you'd got all sorts of costs associated with delivering that house, but you hadn't invoiced it yet? We've got a mismatch again. So we need to look at what we've actually earned when we earn it and put something in our accounts for that. And we also need to recognize costs that we might not have been charged for yet. So if somebody has done us a piece of work, but they haven't invoiced us for it because maybe their processes are not so great, so they didn't invoice us on the day that they delivered whatever it was that they were providing, but you know you've had it, you know you've consumed it, then you should be accruing for that in your accounts as well. So HMRC and good accounting principles say that you should recognize things as the liability becomes yours and as you earn the numbers, as you earn the money. And that's also good for management account principles as well, because this is something else that keeps your numbers clean and smooth. Okay, so cash. So I said I was going to talk about the difference between profit and cash. I've been warbling on about profit. So let's have a think about cash then. So cash, well, it's a little bit more finite, isn't it, cash? Because we can see it in our bank account. I hope people haven't got wads of it under their mattresses, that it is actually in a bank account. And then you can see on your online banking, on your phone app, Or if you're using a piece of good cloud-based accounting software, you'll be able to see it coming through as the open banking drags it through into your software each day. You can say how much you've got in the bank, which is great because it's a thing. It's a thing that you can see, not as piles of cash, but as an amount in the bank. It's a fact. And we like facts. We like things that we can see. But what I would say is, number one, you need to be reconciling that bank account on a regular basis. So you need to know what's actually gone out and what still hasn't gone out. Because if you've put things onto your system for things that you've purchased, but that the money hasn't been taken yet, maybe it isn't due yet, maybe you're on direct debit, whatever that might be, you need to be reconciling that so that you ensure that you have got all of those costs represented in your business as quickly as you possibly can. Real time is what we're aiming for. Real time is not always possible. So let's get it in just as soon as we can. But the other thing is, sometimes you'll look at your business bank account and you've got a receipt for something that doesn't appear in your business bank account because you paid for it yourself. Business owners are great at putting their hand in their own pocket and paying for things, or getting out their own card rather than the business's card to pay for business tax deductible expenses. It happens all the time. It isn't something that we would encourage. We just know that it does sometimes happen. We do encourage people to try and keep this to a minimum because it does take a bit longer to do your reconciliations if this is something that's happening frequently. But you need to be aware that if you've got a receipt, it still needs to go into the business because it is a tax deductible expense, but it isn't going to go out of your business bank account. What we would typically do is create a bank of Joe in there that is money that's come out of my pocket, and then that gets accounted for at the end of the year. But the expense is in the accounts as quickly as it needs to be. So you need to be looking for those things. And there are other transactions that go on in your bank account that you might not have either raised an invoice for or have bills and expenses for. That might be things like bank charges, because we don't tend to get hard copy evidence of those. And also transfers. You know, you may have transferred money into the business or out of the business into your own personal account for directors' loans in lieu of dividends. And that, again, wouldn't come with documentary evidence throughout the year, but we need to understand what of these transactions has gone on. And these directors' loans need to then be coded in the right place, because lots of businesses code them into the profit and loss account because they're a cost to their business, and they think, right, yep, that's where that needs to go. They need to go onto the balance sheet. They're nothing to do with profit or tax. So keep them separate, make sure that they're coded into the right place. So cash is a thing. We can see it in our business bank account. We can understand what's there and make sure that it's reconciled. But we also need to consider things that aren't necessarily there and visible. Things like our VAT. So every time we raise a sales invoice when we're VAT registered, 20% of that, if it's standard VAT rateable goods or services that you're selling, never belongs to you. It always belongs to HMRC, but it could be sitting in your bank account. So your bank account could be inflated by HMRC's VAT amounts. So we need to take into account, when we're looking at cash flow, the VAT that we may have collected as unpaid tax collectors for HMRC. And other taxes. You know, if we've come to the end of the tax year, we might have a corporation tax bill as well, which will be due 9 months and 1 day after the end of our financial year. And we need to take account of that and understand when that cash is going to come out of our business bank account. So we don't look at it and go, oh, great, you know, there's £50,000 in that bank account there. I can go out and spend. I come from an area near Castleford, so we had Viv Nicholson, who won the pools and went out and spend. It was all gone in no time at all. Make sure you're not spending somebody else's money. Make sure when you look at the bank account that you're taking into account these liabilities that you may have.
Yeah.
You come across businesses who manage their business, their finances, through their bank account. Their only accounting principle that they use is, have I got money in the account? And if I have, I can spend it. It's really worrying when people manage their businesses like that. So think about things like that. Also, you know, when you're looking at cash flow projections and what you've got in your bank account, there are other things that can complicate it.
Okay, no worries.
Stage payments can add complications to cash flow projections, and things like invoice financing can too. So invoice financing, typically you would be allowed to draw down 80% of an invoice on the day after you raise it. And then when it gets collected in, it goes into a different bank account, and then you can take the remaining 20% less fees at some point later down the line. So if you're using invoice financing, your cash flow projections will look very different to that other people would have. It's relatively easy. I say relatively easy. That's easy for me to say because this is what I do. It's relatively easy to do a cash flow projection if everything is on due date. So if you create a cash flow projection based on all of the costs that you've incurred and when the payment is due, and all the invoices you've raised and the date that they're due, that's actually relatively easy. If you start adding in things like invoice financing, then that can become much more complicated. And then on top of that, of course, we know that, well, maybe your customers' clients are different to mine, but they don't always pay on time. So we can do our cash flow projection, assuming that all of our customers will pay our invoices on or before the due date. But that's not how life works, is it? Because they do tend to try and keep hold of that money as long as they can. So just a little chart to show you just how long the difference can be for cash purposes between when you spend money and when you get money coming in, just to show you how important it is to get your cash flow projections right and not run out of money. And I'm using manufacturing as the example here because typically manufacturing is the one with the longest spread between spending and receiving money. I suppose unless you're working for the council, in which case that can be even longer. It depends on terms, obviously, it depends on terms. So in this example, we're starting off by ordering some materials. So we're a manufacturer, we need to order materials. We can't make stuff unless we've got raw material components with which to make it. So we order our materials. Now, you may or may not be able to get credit terms with your suppliers. So sometimes you can get credit terms, and that's great because that can then shunt that cash flow closer to when you're getting money coming in. But if you can't, if you're paying pro forma, if you're paying up front, then our cash is going out already. At that first point, we've already got cash going out. Now those ordered materials, they go into stock, and those stock items, materials and other variable costs get added with labour to produce some goods. These are the goods that we're going to sell. So we've got more costs coming in here. We might have heat and light and machine operating expenses. We've got buildings, we've got people costs, and, you know, people get really precious about getting paid their wages at the end of the week or the month. We've got our materials coming into the equation too. So we've got more cash going out. And now we are just at the point where we're producing some goods. So we then produce those goods that go into stock, and then we might get some sales. So somebody places an order with us, brilliant. We've got an order, we can get some money in. So we dispatch the goods and raise the invoice. But our customers, our clients are looking for terms. They look to pay in 30 days or whatever. You know, some of them might pay immediately on dispatch of the goods or before that. But for some people, they're going to ask for terms. So they might be asking for 30, 60, 90 days of terms. Somebody's doing my slide for me there. So some people are looking for terms, so you might have another 30, 60 or 90 days added then to that point of the equation. And eventually we receive payment. Brilliant. We've got some money to come back into this cycle and fund the materials that are ordered to go back around again. But if this whole cycle takes a month, 2 months or more, then we can't stop ordering materials to wait for the money to come back in. Otherwise, we're going to have a very stagnated business. We're going to have to do the ordering materials again and again and again, possibly several times before we've received any money in. And for this reason, when your business is in a steady state, when you're always ordering the same amount of materials, making the same amount of goods, selling the same amount of product or services, then cash flow can be a non-issue. But if you're growing, you're adding more things into the material order process that are expecting you to have the money there long before that cycle comes back round to you getting some money coming in. So just an example then of, let's have a look at the difference between profit and cash and the way it flows, just in a really simple example of this business. So this business, again, we've got the business, we're VAT registered this time, and we've got a very simplistic model whereby we're selling goods for £5,000. We've got the cost of sales 2,500, so we've got that nice 50% gross margin. We've also got some overheads in the business, so we've got £1,000 of net profit coming in at the end of each month, and we're on a steady state. So that's absolutely lovely. Steady state, it's going to happen every month without fail. So that's great. We've made a £1,000 profit each month. Lovely. What happens to the cash? So if we had to purchase goods that we were then going on to sell in advance with the manufacturing example that we already looked at, then we've got goods that we had to buy perhaps 3 months in advance of us actually raising the invoice. We had employee costs that we also had to take account of. Bear in mind that we are VAT registered, our VAT comes later. So we've got the costs of the goods purchased, but then we're going to have the VAT to account for. We'll get some of that back later on. So we're going to get some of the VAT back. We've got overheads coming in inclusive of that. We've got our net profit, our £1,000, but look at our cash. Our net cash is negative to the tune of £4,150 before it goes into the positive when we receive the money. So the reason that I say that we need to be focusing on cash flow projections and understanding our cash forecasts is because of things like this. If you weren't ready for this, if you saw this is great, I can make 50% gross profit on selling these things, and I'm going to make £1,000 a month, you could fall into the trap of thinking that you were all right for cash. But you're not all right for cash, not in the first 4 months. And it would be higher than this if I overlaid month 2 sales and month 3 sales and month 4 sales, because they're just going to bring in month -2, another £1,800, etc. So you need to be looking at your sales projections and the cash that will flow out before it starts coming back in, and make sure that you have got enough cash to keep that business liquid throughout the whole of that process. So when we're looking at cash and profit, there are a number of considerations that we need to take account of.
Joe, sorry to interrupt. Do you want to go to my slides? I don't know why you have the red marks on those. And
they've appeared. I think one of the delegates has inadvertently put those red slides on, and they're just, I don't know how to get rid of them. They're appearing on every slide.
Do you want to go to, I've got a backup copy, we can go to that.
I don't have my notes on that one though.
Oh, okay. All right, we'll carry on then. Sorry. So,
yeah, I don't know how they've managed to do it, but they've inadvertently modified my slides with a few random red lines. So what I want you to do is think about cash, think about reconciling your bank regularly and making sure that all of those interests are flowing through into your profit and loss account as well. I want you to keep your books up to date. I want you to make sure that you do that as close to real time as you possibly can. Put everything into your accounting package as soon as you can. Look at your cash flow projections and consider how you're going to fund any growth that you've got coming in. I want you to avoid overtrading. What does that mean? Overtrading means growing too quickly without understanding the cash that will be taken from that trading. So, you know, it's not only small businesses that do that, but a lot of, if you look at the statistics of businesses failing, one of the highest reasons for businesses failing is cash. So it's poor cash management. It's not having enough cash to pay off HMRC, etc. They're away spending money, but they've not got enough money coming back in. And then they've got other liabilities that potentially weren't taken into account. And now they don't have the cash to pay those. HMRC come in, pull the rug out from under your legs, and suddenly you're in a liquidation situation. But it happens to big businesses too. You know, big businesses with full accounting teams and all the rest of it. There was, you know, many years ago, some of you may remember Sock Shop, the demise of Sock Shop. It's kind of come back in a much smaller guise now, but Sock Shop took over the high street. You know, they were on every single high street and they grew so quickly with so many stores and so much overhead that they ended up, their liquidity fell through the floor. They weren't taking enough in to cover all of their overheads. And it was the demise of the big entity that was Sock Shop at that point in time, and it was overtrading. You know, they had overtraded. There was no other reason for it, and that was about bad planning. So that is the section on profit and cash. The difference between the two and some of the things you should consider when looking at profit terminology and cash flow considerations. Have we got any questions at this point?
There's a question from Philip. Have to go and take urgent call. Thank you for letting us know, Philip. If anybody wants to ask a question, please just unmute your microphone and talk to Joe.
No problem. I can continue on to the next section on KPIs.
Okay.
So I did just try and click into the slide then to see whether I could get rid of the red lines, but I don't know whether it's possible that the only person who can do that is the person who put them in there.
What about just going out of the slideshow and coming back into it?
Should I give that a go? Yeah.
Yeah, just try that.
I'll stop sharing for a moment and see whether that works.
Yeah, just see if that works. Well, that's fascinating. Zoom always brings something up new every time you use it.
Doesn't it just? Yes. Well, we use that ability to scribble on the machine when we do we'll have like team social get-togethers over Zoom and we play Pictionary.
Oh, yeah.
And it works brilliantly for that. But generally that's on, there's like a notes function, a notice board. Yeah. You put them on there. I haven't tried going on
just
onto here to do it. Right, let's see. Share screen.
Oh, right. That looks like it's cleared it.
Is that better?
Yep.
Yay.
Yeah. Hey,
I love it when a plan comes together. Learning as we go in with this Zoom lark. So next section is KPIs. So KPIs are key performance indicators. You know, every industry falls foul of using short code for things that they know exactly what it means. But just in case you don't know exactly what it means, KPIs, they are key performance indicators. And there is absolutely no point in producing three dozen KPIs on a monthly basis if nobody's ever going to look at them. So I've been in many roles where people have created work for themselves, created, you know, the job creation scheme in big business, where they produce a deck of 340 KPIs and slides and all the rest of it. If nobody's looking at it, there is absolutely no value in producing them. So in a small business where we look after the money that we spend a little more closely than I have to say in some of the industries that I've worked in previously, we should be only spending money on things that add value. So I would suggest that when we start talking about KPIs, you only use them if they're going to add value, and you choose the ones that are going to add the most value for you, that they're going to be relevant and, typical for your industry. They need to be measurable. And you should have a way of interpreting them. There's no point you going, all right, I've got a liquidity of 1. Well, what does 1 mean? Is 1 good? Is 1 bad? Is 1 where I had my forecast? Is it above it? Is it below it? Is that good? Is that bad? You need to know what it is that you're doing and why you're doing it. So it's all very well and good, everybody tweeting on about all these KPIs and all the rest of it. But if they're not relevant to you or useful to you, unless you're looking to get somebody else's help or commercial finance or whatever it is, and somebody else is dictating that you need to produce it, then I would suggest don't. Only produce the ones, or have produced the ones, that are useful to you. So we'll have a look at some commonly used KPIs, because there may be a couple, half a dozen in here that would be useful to you, or it might give you ideas of the kinds of things that would be useful to you. So I've put them in areas so that we can group them together. So we've got our sales ones. So we can do average sales value. So I quite like an average sales value, because sometimes average sales value is a good one if you're looking to upsell. So if you're looking to get people to buy bigger bundles or upsell to a higher level of service or whatever, and you might have at the moment, each sale is £200, but you'd really like it to be 300. Because if you can get each sale to 300 and that can drop most of it to the bottom line, that's a massive increase on your profit. So if we look at the average sales value, then that might be something that we can target and then put measures in place to try and increase them, and then look at how far we've come. So we could say, right, well, it's 200 today. I want it to be 300, but actually a year ago it was only 175. So actually we are moving in the right direction. What can I do to get it closer to that 300? And then work on that, report it, look at the difference between the two, celebrate your wins, have a look at what you need to do if you're not getting there as quickly as you want to. And that could, in this sales area, that could be frequency of visit. Now, a great example of frequency of visit is hairdressers. So statistically, again, speaking, if you go to the hairdressers and have your hair cut, the average bloke maybe has his hair cut every 4 weeks and a woman every 6 weeks. If you book an appointment with that person before they leave, then it's likely to be a shorter amount of time than if you leave it up to them. Because what happens is we get busy, and then one day either we look in the mirror or our significant other says to us, you need to get to the hairdressers, look at the state of you. And then we make an appointment, but that appointment might not be for another week or 2 weeks. So if we on average go every 4 weeks, if we book in and our hair needs doing every 4 weeks, but if we don't book in, it takes another 2 weeks to get an appointment. By making sure we make an appointment, we can increase the frequency of visit by 50% over the course of the year. Now, wouldn't that be a worthwhile thing to do? And it's massive on your gross margin and your net margin. So if we're looking at sales and a great KPI for a hairdresser, frequency of visit. And it's not only hairdressers that will be suitable for, that's just one example. So if it is a retail establishment, it might be number of customers. Even if it's not, it might be number of clients. How many clients have you got regularly purchasing from you? That might be one of your key KPIs. And of those customers, those clients, what's the lifetime value? Because if you've got people coming back more frequently, then what's the value of each client that you acquire over their lifetime? If the lifetime of a client is a year, 2 years, 3 years, multiply that up and have a look then at how much that lifetime value is. Because if you're questioning your marketing spend on acquiring a new customer, once you've worked out the lifetime value of a new customer, actually that marketing spend might seem a lot more reasonable right now. So having a look at things like that can help decisions around marketing spend. How much is that marketing spend? How much does it cost you to acquire a new customer? Based on the other things that you've got above, that might be a good indicator or not so good. How often are you getting repeat sales? You might even want to look at, how well each particular sales rep's doing, or a location, or a particular product or a service, and that can be deemed a KPI as well. And KPIs don't even need to be numerical. They can be anything that you want them to be. It can be a number that you report, but against a thing. While I was in industry and in manufacturing, as you can imagine, health and safety was really, really high on everybody's priorities. And we would look at number of slips, trips and falls, number of reportable accidents, number of days since the last accident. These are things that are not necessarily truly financial things, but they are very, very important to certain industries. So margin, gross profit, net profit, obviously we've already had a look at those things, but we might have a target percentage for those. So if your currently net profit is 40%, you might want 45 by the end of next year, and you might want to increase your prices or look at how you might get costs down in that area so that you can improve it. Growth, we'd often have percentage increases for growth. As compared with what? Well, the same month last year, year to date, up to this point compared to last year. Month on month growth we might be looking at, anything like that. Us accountants, we quite like debtor and creditor days. So this is how many days does it take a client typically to pay your invoice? If you've got 30-day terms and your debtor days are 62, then it's possible that you need to put a little bit more effort into your credit control. Either that, or have a look at your customer base, because if they're not paying, suddenly you're a charity. Either that or it's theft. So we need to have a look at things like this to make sure that we're not letting things slip because we're busy, and look at where we need to focus within a business. Creditor days, that's how many days it takes you to pay your suppliers. And in a lot of industries, they're looking for parity on these things. So either that or debtor days to be less than creditor days. For me, I run a small business who deals with small businesses. If I receive an invoice from any kind of small business, I pay it typically the day that I've received the services, because I think that that is the only fair and equitable thing to do. So my creditor days are really, really low. My clients and customers don't necessarily have the same point of view, although I do use direct debit for a lot of things. So that does really help with keeping debtor days down. Stock days. So if you are somebody who is manufacturing, who is buying and selling stock of some description or another, number of stock days is useful. So if your sales are X per day and you've got this amount Y in stock, you divide one by the other and find out how many days of stock you've got. And, you might be tying up all of your cash in stock because your stock days is 305. Who needs 305 days of stock? There was this thing when I was just leaving university called just in time, which was about buying things in just in time for you to consume them, just in time for you to sell them. Well, that is quite a risky thing to do, because if it's late, then you might miss out on the opportunity of a sale. But it's great for not tying up money in working capital. And actually, industries have moved further and further towards this. And back when I used to work as a part-time job in a supermarket, when I was doing my driving lessons and my A-levels, the warehouse was like maybe a third of the size of the store in the supermarket. Now the warehouse is tiny. They don't have a lot of stock replenishment space taken up in their store, number one, because it's an expensive commodity to keep the overhead on that. And you could have people walking up and down aisles in that space. And number two, stock is a very, very expensive commodity. So the lower your stock is, the less money that you've got tied up in it, which is great. So cash days is a way of working out how many days till the cash runs out. So you'd need a cash flow projection for this, obviously, but good to know whether in 2 days' time you're going to be having people knocking at your door, or whether actually you're all right for cash. Liquidity is an account in an industry term, and it's a few different calculations for this, but it's about whether or not you can afford your outgoings. So it's looking at things like debtors and creditors and stock, and saying, well, can you afford to pay all the people you owe money to? And there's like quick liquidity and regular liquidity and all sorts of different ones, but mainly used by banks and large industry bodies. EBITDA, again, another thing that's used by large businesses, so earnings before interest, tax, depreciation and amortization, which is a term used for spreading goodwill. Let's have a look what else we've got. So really very specific targeted KPIs might be attendance, and that might be attendance, you know, so what level of sickness absence have we got? Or it might be that you run events. So you run an event and you're looking to have to break even on your event. You might need 10 people there or 100 people there, depending on the size of the event, the overhead that you're going to incur. So what attendance do you have on events? That might be a good thing if that's the kind of thing that you do. Pass rate, if you're doing some kind of certification program with an exam at the end of it. When I'm doing my training for QuickBooks, we get, obviously we look at the number of people who pass the exam at the end of the day. We also look at people's ratings based on how much they felt they gained from that session. And it's important to understand that kind of thing when you're putting on events that are about knowledge base, and certainly if there's an exam at the end of it. 5-star reviews, you might have a KPI that says, actually, I get lots of new business from people searching on Google if I'm at the top of the 5-star review poll. So if you then get lots of 5-star reviews, you're more likely to get more customers coming in. Therefore, you need more 5-star reviews. So how many 5-star reviews did you get this week, this month, this year, whatever? What's your target? How can you go about getting more? You might look at returns or refunds, if it's consumer goods, how many people are sending those back and why? Because there might be a quality issue or a sizing issue, which allows you to then modify your business model to take account of that. You might have referrals as a source of gaining new customers. So you might have that as one of your KPIs. How many referrals did we get in this period of time? And again, with things like this, if referrals is a really important thing to you, how do you get referrals up? Well, you ask. If you want more 5-star reviews on Google and you've done somebody a piece of good work, ask them for a review. If you want people to refer you, tell people I have a referral strategy. And if you refer me on to somebody else, not only will I be really grateful because I am looking to take on more customers, but there might be something in it for you. And, people will offer, 5% off your next purchase, 10% off your next purchase, whatever it might be, some kind of incentive for people to tell other people how well you've treated them. And that is a great way of getting new business. Might be employee or customer satisfaction, and often these are done through surveys. People hate surveys, by the way, so if you're going to do a survey, I would suggest keeping it short. Other things might be number of visits to your website, so using your Google Analytics, how long people spent on your website, which pages they looked at, how many of those things converted into enquiries or new business. Might be likes on Facebook or other platforms, although I must admit I did go once onto a course about social media and they were banging on about likes on Facebook and how they got all these likes on Facebook, and I just don't think you can bank them, So likes on Facebook are a great vanity project, but unless they're converted into sales, then they're not actually that useful to you. Or I suppose unless you're looking for exposure, if it's all about recognition in the marketplace, then maybe that would do it for that. Staff turnover, so how well are you treating your staff? The cost of bringing in a new member of staff can be agency fees, training, all sorts of things. Should you be looking after your staff better if your staff turnover is high? Accidents, like I say, in a manufacturing environment, that is a really, really key thing to look at. Waste levels, if you are converting goods into a final product, how much waste do you have along the way? Machine stoppages, again, these are manufacturing type KPIs. So just in summary, on the KPIs section, I've suggested lots of different KPIs that you could use, and not all of those are going to be relevant to any one of you. And I do suggest that you should choose very carefully the ones that are important to you, but help you to manage your business and move it in the direction that you want to move it in. So a great KPI would be one that if you had a high level strategic vision that said, I want to double the size of my business in the next 2 years, and then you drill underneath that and say, how am I going to do that? I'm going to increase my customer base. I'm going to increase the average value of each sale. I'm going to increase the frequency. I'm going to reduce my cost, whatever it might be. Look at that. And as it comes down, look at the KPIs that support that and how those KPIs are measurable and how you can have targets for them so that you ensure that you're moving your business towards that target that you've got at a strategic high level. There is no point producing KPIs that are neither relevant nor useful to you in your business. So that is the end of the KPI section. Does anybody have any questions at that point?
No questions. I'd just say, Joe, that I mean, you're certainly going a lot wider than just accountancy, because you're really talking about a strategy and how KPIs underpin, because with any business strategy, you need to measure.
You do.
You need to measure. How do you know you've got to where you want to be if you don't measure it? So that's great.
There's a great phrase, isn't there? If you fail to plan, you plan to fail.
Exactly. So we're just at 1 minute past 1. So I know how many more slides we've got to go, but it's not too many. So if we can try and finish about 20 past.
I think we'll be on for about that. I think we will.
That's
be.
Super, because I then just need to the last 10 minutes just talk to the delegates. Okay, thanks, Joe. Carry on. Oops, hang on, you're blowing your nose. So
it's a winter sniffle, nothing else. Just saying. Not that you can catch anything over Zoom. I am told reliably that it is not possible to catch anything over Zoom. So so we'll go on to management accounting then. So management accounting, management information. So several times in my career, I have been a management accountant, and I would like to consider that I am a commercial management accountant, and that being somebody who is very interested in the profitability of businesses. So management accounts, again, can be death by numbers. And I really don't see the value of that. I know I love churning numbers. I do. I'm going to declare that now. I love churning numbers. I love a spreadsheet. I love doing analyticals on any kind of set of numbers that you've got, but they have to be meaningful. And I have many times in my career gone to the senior board, the senior management team, brought them my pack of management information, and not a single question has been asked. Or I've distributed them and nobody has come back with any questions or anything, comments about them at all. And I've said, what's the point in me producing them? If you're not going to look at them, if you're not going to interpret them, if you're not going to comment about them, then I'm just wasting my time. I might as well go and do something else. So that's the first thing to understand about management information. It must be useful, and it must be useful to you. If you're the manager, owner of your business, the most important person to find this information useful is you. So management information is at its highest level information used to manage your business, used to make what I call eyes wide open business decisions, used to understand how well your business is performing so that you can modify things as we go. And you know, that is the best skill that we as small business owners have. We can turn on a sixpence. So if COVID hits, if we're coming out of Europe, whatever it might be, the small business community is so well equipped to just make decisions like that, to pivot their business model on a sixpence. And management information allows us to do that in a much more considered way, so that we're not making guesses, we're making educated guesses because we don't know the future. None of us have a crystal ball, not even me. Honestly, I thought I was going to get one with my accountant qualification because the number of people that were asking me to predict the future, I thought I'll get this when I get my qualification. No, none of us know the future, but we can have a really good stab at guessing what it might look like. Particularly that is quite close to us because we've got a good idea what's going to happen tomorrow, next week, the week after. We've probably less idea about next month, next year, etc. So the value of management information in the way of forecast goes down over the time. So the amount of time we spend on it should go down over the time because there's no point spending huge amounts of time working on a forecast for in 5 years' time because there are so many external influences that could change that in the meantime. That should be at a much higher level. So we spend our time pulling together management information, and the first thing that we're going to do is set some targets, because management information in itself is quite a cold fish if there's no to compare it against. So we need some forecasts or budgets and maybe some KPIs. We might want to compare to last year, and that's the easiest thing to do. If we were trading last year, we've got that data. And we're going to use this information that we compile to make some management decisions, which might be routine information that we produce every single month, or it might be one-off information that is project dependent, decision dependent. And we're going to use this information to plan for the future so that we are better equipped to deal with the future when it becomes the present. So we're going to support operational decisions with our management information. So we might be looking at things like trends, seasonality, so that we can plan for a dip in our cash flow, in our sales, because we never have anybody through the door in December, or we're always quiet on a Wednesday, or whatever that might be. Those can also be industry trends that we overlay into our numbers. We might look at our results versus our target, versus our forecasts and our budgets, and just, again, industry terms, what's the difference between a forecast and a budget? Only timing typically. So a budget would typically be done once a year, and a budget often would be for more than 1 year, whereas a forecast is done more often, and it's done as often as is meaningful. So when I've worked in industry, when I was at Fox's Biscuits, their forecasts were done every month because the world's changing constantly. Supermarkets changing what they want. Consumers are going on diets or deciding that they don't want to eat chocolate because they've gone vegan and it's got animal product in it, or whatever it might be, low salt, or all sorts of different things changing all the time. And listings affect that, and all that kind of thing. So we would do a budget once a year, big exercise, do the budget, link to the strategic plan. Where do we want to be at the end of this budget period, which might be 3 or 5 years down the line? And then after that, bring in some forecasts, which might be, if you've got the resource to do it every month, then perhaps you do it every month. But for lots of small businesses, they wouldn't do forecasts every month, but they might reforecast when COVID hits, because suddenly their budget is totally meaningless because they're closed. Now you might want to do a reforecast, or you might want to do a reforecast because you've just won a big new contract. And suddenly all of your cost base and the sales revenue you're going to bring in is all blown out of the water because you've got this new contract, and your forecast will then be the numbers associated with the big new contract. So you might want to overlay those kinds of things, or you might want to do a quarterly or half yearly refresh. If you're a million miles away from your budget number and you know the reason why, then you might want to build in and have a set of forecast numbers that are more meaningful to you mid-year. So we look at our results versus our targets, as well as last year. I like to look at both. We might want to look at staffing numbers for operational decisions. So as our sales go up, do we need more people? So if we're forecasting a trend that is a rising sales revenue, what numbers of people do we need for that? And what's the lag? How easy is it to get those people? Do they need training up? Are we going to be using overtime in the meantime? And maybe that's at time and a half. What level of efficiency have we got going on in our numbers? Sickness, absence, all that kind of thing. And how do all these things affect our cash flow? Are we going to have our sales go up to a point where we can't actually get hold of the goods quick enough? We can't turn the goods around, manufacture them quick enough? And will we end up with product shortages? So this is another great reason why we should be planning ahead. Are there any service delays? What's our level of waste, customer satisfaction, all that kind of thing? So these are all really useful operational decision-making management information numbers. So there may be KPIs or there may be financials, but they're really important for operational decision making. So management information packs, you know, if you've got a management information pack, what would that look like? Often when I'm producing a management information pack, I'm going to like a few graphs in there. I'm going to look at this year's sales versus last year. I'm going to look at gross margin. I'm going to look at profitability. I'm going to look at versus last year versus forecast, both in the month and the year to date as a core. And then over and above that, then it really depends on what's useful to the business. So it's got to be useful, it's got to be relevant, it's got to be measurable. So let's, you know, include things like, you know, if we're going to do an investment and we're using management information that isn't routine management information, now we're doing it for decision making. So we would typically have, I've done a lot of project appraisals in my past. So we're thinking of creating 10 new jobs by producing this new product, and we need to spend £1 million on a new machine. So before you start spending that money, before you start finding out how you're going to get the money in the first place, you need to work out, well, how profitable is that going to be? Over what period of time? If I'm spending £1 million, how many years, months will it take me to earn that money back? What is the return on my investment going to be? Because, you know, I was working for big corporates, so therefore they had shareholders. Shareholders are very interested in the return on investment, ROI. And we would need to look at all of the details associated with that particular project, the output, what sales would we achieve? Would we have any cost savings because of what we were doing? Could we reduce waste? What would it be? If we're taking on new staff, how many would we be taking on? What would their output be? We might want to measure the sales per member of staff or sales per pound of staff costs, reduction in waste, whatever that might be. And we would put all that together in a project plan, which would be overlaid on the forecast if we decided to go ahead with it, and the cash flow projection. And then after the project has gone in, you know, a year down the line, we would go back and do what's known as a post-project appraisal and look at, well, how did we fare against those numbers then? How good were our estimates? Because we are constantly learning. And everything we do, we can do better with more knowledge and more experience. So if we do a project plan and we don't hit it, whether we're off on the money or the time or the sales didn't come in or we needed more people and we couldn't recruit, whatever it might have been, we need to understand all of those things. So should we come to make a similar decision in the future, we now have more in our arsenal to make a better decision. So we would understand and learn from that process. So other things that we'd need, if we were launching new products, we'd need to know the timing. So when are we planning on putting that out to the market and what volumes do we expect to achieve? What impact is there likely to be on other products? It's known as cannibalization. So if I'm Fox's Biscuits and I'm bringing out an orange variant of I'm trying to think of one of their biscuits now. Let's say it's a club biscuit. I can't remember whether that's something that they make or not now. I don't think it is. But let's say it's a club biscuit and I've decided I'm bringing out an orange variant. I can't expect my sales of my standard variant to stay as they were every other month, because there will be some people who switch, who go, oh, actually, I'm going to go with Orange Club this time instead of the standard club, rather than switch away from Breakaway to an Orange Club. Do you see what I mean? So it's absolutely fine if those sales, when you're bringing in a new product, it's brilliant if you then take those sales from your competitors, but sometimes you take some of those sales from yourself, and you need to understand that. What would the impact of bringing this product out have on the rest of my product portfolio? People have only got a finite amount of money that they want to spend or chocolate bars that they want to eat. So you need to consider all of those things. What margins are you likely to achieve as well? So you'd look at that with any kind of product launch. If it was promotions, so you need to look at uplift. So again, you know, an example of Fox's Biscuits, they did a promotion and it was a buy one, get one free. And they got 20 times uplift of sales. 20 times uplift. Nobody was expecting it to be that big. It was clearly a very compelling offer. So when you put a promotion in, because you've decided that you're going to do, whether it's a money off or a link sale, whatever it is, if that's expected to increase your sales, by how much? And have you got the stock or the people to be able to support that level of sales? And again, with a promotion, what amount of margin are you going to end up with? Because there is really no point being a busy fool. If you're going to put in a bog off and not make any money on it, then what is there any point you going out of your way to produce those goods? So, and if you put in a promotion and you've got a suite of products and this one's going on promotion, what will the impact be on any products that are not on promotion? And are you going to go off sale because you're going to sell such a lot of them? When Cadbury's brought in the white chocolate flake as well, that was off sale everywhere because they just couldn't make enough of it. Nobody was buying the milk chocolate flake. Everybody wanted the white chocolate one and they just couldn't make enough of them. So marketing, if you're doing something marketing wise as a project, then you're going to need to know what the impact is going to be on sales or brand awareness, if that's what you're doing the marketing for, or your market share. Are you going to win new business? How much new business? Will you get repeat business from that new business? And what will the average increase of sales value be if that's the way that that marketing is going? So just understanding what you're trying to achieve. And then some other big decisions that you might make. If you're doing manufacturing, it's possible that some of the things you're buying, you could actually make rather than buying them in. And that make the buy decision is a huge decision. You can generally make significantly more margin because if you make it as efficiently with the same level of waste and cost base as the person who's currently supplying you that made up thing that you're buying, you're going to get the margin that they're making. So a make versus buy could mean that you need to make significant investment, but it could elevate your margin really quite well. Investment decisions, you know, you're looking at moving premises, you're looking at adding products or services, changing your offering, you know, looking at different packaging, you know, putting the offering out there in a different way. Pricing. You know, pricing is something that I speak about a lot and I'm really quite passionate about pricing and getting pricing right because it has such a massive impact on profitability and your bottom line. And pricing is quite a big decision if you're going to change it. So, you know, if you go in low, increasing it can be difficult. If you go in high, reducing it is quite easy. But if you go in high, nobody might buy it, you know, and you really need to try to get that right and get your optimal price. But you may end up with people saying no. You know, if you always quote for your services and people always say yes, then you're not charging enough. But you need to then take account, if you put your prices up, of the fact that not everybody will say yes. And that can feel a little bit like, you know, a personal affront on your ability to provide the services. It's not. It's a commercial decision they're making. And you should have people saying no. If they're not saying no, you're not charging enough. Anyway, that's another story. I could talk about that all day. So forecast versus budgets. If we're creating a forecast, we start with history as a base because we know about that. And then we use assumptions to build the future because we don't know about that quite so well. So we might say, well, on average, we've always sold this amount. So if this number of customers come in with this level of repeat buy-in and this average sales, that's what we'll get going forward. So use scenarios, assumptions, and then overlay scenarios. So what happens if we get a listing in this store or this media platform or launch new products, whatever? Overlay those on top. Think about the timescales of everything and ensure that if you are building a sales profile that's growing, you've got the variable cost going in line with those sales at the same time. Otherwise, it's all just got disconnected. And then use these forecasts or budgets to compare against actuals for your management information to do your eyes wide open business decisions. But I just want to touch back onto that one of those accounting principles that is the matching. If you're using your base data for the forecast, it needs to get rid of those lumpy costs. So you need to make sure that your matching's been smoothed, because if you haven't, then it's going to be really hard to take those and move them forward into your forecast. So if you do hold stock, think about how you're going to work out that stock value. It's the biggest thing that affects people's numbers and ends up with their gross margin going up and down. And looking out of control when perhaps it isn't. And keep your bookkeeping up to date. Please keep your bookkeeping as up to date as you possibly can and as accurate as you possibly can. And reconcile that bank account and make sure that you know everything that you've spent, what you've spent it on, and it's all been accounted for. And that is all I want to tell you today, because I'm sure that is more than enough to have your heads wanting to explode. So any questions at that point in time?
Yeah,